Welcome back to The Explainer. Today, we are tackling an absolutely fascinating topic. We're going to decode the notoriously complex world of financial derivatives, but we're doing it with a bit of a Hollywood twist. We're going to look at three blockbuster films, The Big Short, Margin Call, and Rogue Trader, and basically separate the cinematic drama from the hard financial reality. We'll explore exactly how these massive market failures actually happened in real life and the precise mechanics behind them. Okay, let's dive into this. To give you a rigorous analytical framework, here's our agenda for today. We'll start with an executive summary, move on to the identification of the instruments involved, do a root cause analysis, look at risk management strategies, and finally, bring it all home with the local context in Malaysia. All right, let's kick things off with our executive summary and film overviews. To really understand the math, we first need to understand the historical eras and the cinematic drama that brought them to life. Because our three case studies spent completely different eras and markets, right? We're starting way back in the mid-90s with Rogue Trader. This perfectly captures the high-stakes world of emerging market speculation that literally caused the collapse of Barings Bank in 1995. Fast forward a bit to the 2003 to 2008 era with The Big Short, which brilliantly shows us the swelling and inevitable bursting of the U.S. housing bubble. And then Margin Call gives us this intense, claustrophobic, 24-hour window into an unnamed Wall Street investment bank right at the absolute peak of the 2008 fire sale. So let's quickly break down the core of these stories. In Rogue Trader, we follow Nick Leeson. He's a star derivatives trader who somehow manages to single-handedly generate an £800 million loss through unauthorized, highly leveraged speculation. Crazy, right? Then, in The Big Short, observant outsiders like Michael Burry and Mark Baum realize the U.S. housing market is essentially a house of cards built on risky loans. Finally, in Margin Call, you've got a panicked boardroom led by CEO John Told reacting to risk analyst Peter Sullivan's terrifying discovery that their firm is catastrophically overleveraged in toxic assets. Basically, each film shows us a different flavor of market failure, a rogue individual, a systemic housing collapse, and total institutional panic. Moving right along to Section 2, Technical Identification of Instruments. Now, what's really interesting here is demystifying the actual financial tools these characters were throwing around. In both The Big Short and Margin Call, the core underlying assets of the 2008 crisis were residential mortgages, specifically subprime mortgages. And hey, when we say subprime, we literally just mean high risk. These were loans given to borrowers with poor credit histories. To make matters worse, a lot of these were adjustable rate mortgages, or ARMs. These had low initial fixed rates that eventually reset to much higher variable rates. This created massive uncertainty and sudden payment shocks for everyday homeowners, which, as you know, led to mass defaults. Now, if we shift back in time to Rogue Trader, the underlying assets were completely different. Nick Leeson was trading derivatives based on Asian assets, specifically Japanese government bonds, which are generally considered to be incredibly safe debt instruments backed by the government. He was also trading based on the Nikkei 225, which is Japan's leading blue-chip stock index. The real tragedy here is that these relatively stable, everyday assets were basically weaponized through the extreme way Leeson traded them. Okay, let's look at the derivatives that actually amplified the 2008 crisis. First up, a collateralized debt obligation, or CDO. Think of this as essentially a repackaged bundle. Banks took thousands of those risky subprime mortgages we just talked about, bundled them together into tranches, and then sold them to investors as highly rated, supposedly safe products. A credit default swap, or CDS, on the other hand, is basically just insurance. It's a derivative that pays out if the underlying borrower or asset defaults. In The Big Short, Michael Burry basically buys a massive insurance policy on those bad mortgage bundles, betting that they would fail. For Nick Leeson, his weapons of choice were futures and options. Futures contracts are just standardized agreements to buy or sell an asset at a future date. But the crucial concept here is leverage. Leeson only had to put down a tiny margin to control a massive long position on the Nikkei 225. He also used options, specifically a strategy called a short straddle, where he sold both a call and a put option. Now here is why you should care about this. This strategy only works if the market remains perfectly flat. Relying on a perfectly stable market is a massive, uncontrollable gamble that can wipe out your entire portfolio. So when the Kobe earthquake hit in 1995 and the Japanese market inevitably crashed, his unhedged, highly leveraged positions turned into an absolute financial disaster. This brings us to Section 3, Root Cause Analysis. As we do an autopsy on these failures, I want you to ask yourself, does the fault lie with the instrument, the person, or the regulations? When we look closely at these failures, we see a really sharp contrast between systemic rot and human deception. In The Big Short and margin call, the failures were largely systemic. You had faulty mathematical models that just completely ignored extreme market volatility. You had massive conflicts of interest where rating agencies were actually being paid by the very banks they were supposed to regulate, plus a totally intentional lack of transparency around complex products. On the human failure side, the market was just flooded with ninja loans, no income, no job, no assets. Over in Rogue Trader, the human failure was even more direct, blatant fraud. Nick Leeson utilized a hidden, unauthorized account 88888, to completely conceal his massive losses from his superiors. I really want to pause and emphasize this staggering number, £800 million. That is the amount of money Nick Leeson managed to lose and hide from Barings Bank. That's nearly twice the bank's entire capital. How on earth does that happen? Well, it was due to a catastrophic lack of segregation of duties. Leeson was allowed to be the head of both the front office, making the trades, and the back office, settling them. He was literally policing himself. And this brilliantly illustrates a clear conclusion from our source materials. Financial instruments like CDOs and futures contracts aren't inherently evil. They're just tools, but they act as incredibly powerful amplifiers for human flaws. Across all three of these movies, human greed, a relentless focus on short-term profits, and prioritizing institutional survival over basic ethics were the true catalysts. The instruments magnified the damage, and the weak regulations permitted it. But the root cause? That was always human behavior. Okay, let's pivot from the problems to the solutions in Section 4, Risk Management Strategies. How could these cinematic disasters have been avoided in the real world? It's absolutely crucial to understand the difference between hedging and true risk management. Think of hedging as treating the symptom. Sure, you can use a credit default swap or take an opposite short futures position to financially offset a loss if the market turns against you. But risk management? That's treating the disease itself. As our source notes suggest, the ultimate mitigation strategy across all these scenarios is a robust, systemic risk management framework that prevents your exposure from getting completely out of hand in the first place. So, what does that actually look like? Well, a proper framework requires a few key things. First, the strict segregation of duties. You have to separate the traders from the risk monitoring teams. Second, you run rigorous stress testing and value at risk, or VAR, analysis. This helps you assess how your portfolios will hold up under extreme market conditions, which is exactly what the bank and margin call completely failed to do accurately. And third, you implement strict position limits to curb excessive risk-taking. Barings Bank, that unnamed Wall Street firm, and the broader U.S. housing market all catastrophically stumbled over these basic fundamental hurdles. Finally, Section 5, the local context. Let's bring this Hollywood drama back home to reality and look at Malaysia. How would these exact scenarios be handled today under the current regulatory framework right here in Malaysia? Well, the Securities Commission Malaysia takes a highly proactive approach. They mandate proper corporate governance and require robust internal controls. Most importantly, they enforce the strict segregation of duties. Under this framework, a trader could never run both the front and back offices like Nick Leeson did. They also demand accurate and transparent risk disclosure for complex products, specifically designed to prevent that unchecked buildup of hidden, toxic risks that we saw in The Big Short. On top of that, Bursa Malaysia Derivatives actively regulates the trading platforms for futures and options. They enforce strict margin requirements and position limits, and they use daily mark-to-market procedures. Basically, these market controls are specifically designed to restrict the exact kind of excessive leverage that doomed Barings Bank and to severely limit counterparty risk during highly volatile market conditions. So our regulatory frameworks are incredibly robust today, designed specifically to catch the mathematical and systemic errors of the past. But, as we've learned from these films, derivatives and financial tools are simply multipliers of human intent. Regulations have absolutely evolved, but human nature and greed, that pretty much remains exactly the same. So are we truly safe from the next cinematic market failure, or are we just waiting for the next sequel? I'll leave you to think about that. Thanks so much for joining me on this explainer, and as always, keep questioning the numbers.